Cryptocurrency markets operate as engines of continuous volatility, defined by severe, unpredictable price swings. A raw, unmanaged buy and hold strategy on a benchmark like Bitcoin yields a 32.51% absolute return, but it forces investors to absorb massive drawdowns and extreme structural risks. This line chart plots that volatile benchmark against the performance of a deep Q network arbitrage agent. While the raw benchmark secures higher yield, this DQN agent achieves an 18.39% annualized return while compressing volatility down to 12.22%. The result is a Sharpe ratio of 2.43. By deploying advanced deep reinforcement learning and transformer models, quantitative strategists are replacing static trading rules to optimize risk-adjusted returns across decentralized finance. In this environment, durable alpha is produced by high Sharpe ratios and the systematic elimination of extreme downside risk. Decentralized finance relies on an architecture of composable smart contracts, interlocking blocks of code executing trades, loans, and derivatives on public blockchains. These systems operate on static execution rules. When market regimes shift suddenly, those fixed parameters fail to adapt, leading to liquidations and arbitrage bleeding. To survive this environment, institutional capital is shifting toward dynamic neural architectures that abandon fixed rules in favor of continuous learning. Two specific neural network architectures illustrate this shift. A deep Q network targets the micro-execution of individual trades, while a transformer-based variational autoencoder handles the macro-allocation of the entire portfolio. Dynamic intelligence serves as the bridge between programmable logic and the reality of market volatility. Unlike traditional equities, digital asset liquidity is fragmented across dozens of separate decentralized exchanges. This fragmentation creates momentary price disparities, fleeting statistical arbitrage opportunities, where the same asset trades at two different prices simultaneously. To exploit these discrete action spaces, quantitative systems deploy a deep Q network, or DQN. These two parallel order book ladders reveal the model's exact input state, a momentary price spread anomaly between DEX A and DEX B. The DQN executes an instantaneous synchronized trade across both order books to capture the delta. The algorithm does not attempt to predict directional price action. It strictly mines execution inefficiencies, extracting a mathematically derived edge. This execution speed relies on a continuous feedback loop. The model observes the market state, takes a trading action, and measures the exact result. This cyclical flowchart outlines the agent sequence. The reward function optimized is the realized spread captured, minus fees and slippage. Across thousands of iterations, the network updates its internal weights to maximize this metric, learning when to trade and when to remain sidelined. That constant self-correction is the mechanism behind the 12.22% volatility drop. The model automatically learns to avoid trades that destroy risk-adjusted capital. By mathematically optimizing the reward function based strictly on spread and cost, the algorithm automates risk management more effectively than manual hedging. Securing alpha on single trades has minimal impact if the broader portfolio allocation is flawed. This requires a pivot from micro-execution to macro-allocation. Crypto asset price data is noisy and non-stationary. Standard predictive models fail when attempting to process these chaotic historical sequences. To structure this data, developers utilize a transformer block, leveraging its self-attention mechanisms to weigh the importance of different temporal patterns in the market. Next, sequential price data feeds into the transformer node, funneling its processed output into the bottleneck of a variational autoencoder. The VAE compresses the noise and extracts clean, disentangled trend representations, distinct mathematical regimes. Instead of forcing a network to blindly guess future asset weights, the VAE isolates the underlying market structure, turning chaos into readable states. This 3D coordinate plane maps these readable states into a latent space, clustering current market conditions into bullish, bearish, and ranging environments. To execute trades, an actor-critic model constantly monitors this specific latent space. This introduces strategy-level control. The agent does not calculate raw asset percentages or attempt to predict individual coin performance. Instead, the actor dynamically selects from a pool of predefined expert strategies, such as momentum or mean reversion, based strictly on which regime cluster the VAE currently identifies. By trading mathematical strategies rather than holding raw underlying assets, The agent insulates the total portfolio from sudden, token-specific volatility. These deep learning models share a critical vulnerability: sudden structural breaks in the market, lacking reference frames to process unprecedented black swan events. When market conditions shift into territories completely absent from their training data, performance degrades rapidly. Assuming normal market conditions, we can see the ideal smart money DeFi stack. The composable smart contracts are governed by an active DQN micro-execution layer on the bottom and a VAE macro allocation layer on top. They form a strict symbiotic relationship. The DQN manages the micro-execution of arbitrage, while the VAE dictates the macro allocation of the broader portfolio. A converged AI stack represents the current pinnacle of DeFi asset management. Yet, even the most rigorously optimized architecture remains fully exposed to unmodeled, anomalous tail events. The limitations of legacy buy and hold strategies cannot survive the speed of decentralized exchanges. Adaptive AI agents continuously process state, action, and reward in real time. These agents operate within a continuous action space, recalibrating their behavior in ways that standard rule-based algorithms cannot. True alpha in the modern cryptosphere is the ability to maintain continuous portfolio optimization while systematically suppressing downside volatility. The highest risk-adjusted returns belong exclusively to the quantitative systems deploying transformer-driven intelligence